disconnect, obviously, between the so-called fundamentals and the market has been a point of anxiety for a lot of commentators and market participants. But as you say, that Friday non-farm payroll report, Nancy, would have to be the largest data surprise in economic history, with the market anticipating a decline in jobs of 7.5 million, with the outcome being a rise of 2.5 million jobs. I mean, 10 million jobs missed in a single month. There's no precedent for that. But we live in an age of no precedent for pretty much anything that's happening. So I think with regard to my views on that, clearly the BLS put out an explanatory note, as there's all kinds of issues in collecting data because they do phone call surveys, et cetera, et cetera. So there was a lot of issues, not just in this non-farm payroll report for the current month, but the prior month as well. So I think there's a lot of statistical noise, perhaps, in the data. But having said that, clearly we're now looking forward to a reopening of economies right around the globe. And whilst there is still high infection rates in certain localities, such as obviously South America and other areas, for us here in Australia, for example, the data or the infection rate and the fatality rate has been better than previously anticipated. We're seeing reopening now pretty much around the world. So we are getting an improvement in the economic data, Nancy, but we have to acknowledge that we've come from a very, very deep, dark chasm. Therefore, we've got to view the data rebound in that kind of context.
Yes, and an improvement is something we all look forward to, but let's be honest, I mean, the dire numbers of unemployed in America is still just horrific. But be that as it may, you're talking about the broader trend, which is reopening, going better than many had hoped or feared in some cases. So is this the time to pick up names that were just especially hard hit? I understand, for instance, that you think banks are looking more attractive.
Well, I do, Nancy. I've actually been holding back on buying banks for a while. Clearly, they got hit very, very badly in the crash, and then they kind of didn't do very much, whereas the rest of the market started rallying. And there was a lot of concern and anxiety around bank valuations, and the prices were very depressed. So we saw, very dramatic declines in the financials right across the globe, here in Australia, in Europe, and in the United States. And I was just watching them very carefully, and I felt that on a valuation basis, in particular price-to-book ratios, we saw, dramatic declines. And we also knew that many institutional investors around the world were very underweight financials, and for good reason, and had been for some time. So the classic, trade had been, long the growth sectors, the tech names, the so-called FANG stocks, and very much underweight financials. And eventually that valuation dispersion got to, record levels. And as a contrarian, I always kind of keep an eye on that kind of valuation dispersion, and it was right out there. The elastic band was as stretched as we've ever seen.